So today we're gonna be talking about how much you actually pay for a 30-year mortgage. So definitely stick around. First, if you are new here, my name is Dennis, and on this show, we love to talk about personal finance, investing, and retirement to help build your wealth. So definitely consider subscribing today, and don't forget to hit that little bell icon to get notifications when new videos and live streams go up. All right, so a little while ago, I made a video where I talked about how much you can impact your mortgage when it comes to adding $100 extra every single month. You can check that video out here in the cards up above, and also in the description box down below after this video is completed. But I wanted to go into more detail on how much you actually end up paying for a 30-year mortgage. So what we're gonna do is we're gonna go over and hop onto the computer so that way we can get some more of this information, so that way you can better understand how much it really costs to have a 30-year mortgage. All right, so here we are on the computer. We brought up a website called smartasset.com. I will have a link in the description box down below so you can check that out if you'd like on your own. What this website does is actually have a bunch of different calculators for you, so you can input some numbers and get some ideas of what it's going to cost you to have certain things such as a home mortgage, car loans, all these different things. But of course, today we're looking at the home mortgage, as we were just talking about. And so what we're going to do is we're going to plug in some numbers, and of course you can go ahead and plug in your own numbers so you can see the actual effects of what you're looking for as far as homes and the costs and what you're going to end up paying. Let me know in the comment section down below, how much more time do you have left on your mortgage, and are you paying extra towards it every single month? Now we're going to go ahead and start with this, where you're going to see $300,000 for the home price. Now depending on where you live, the homes might cost more or might cost less. So this is what we're going to start off with. We might plug in some additional numbers to kind of see some differences here, but we're going to start with this $300,000. As far as down payment, we're going to start with $10,000 because I believe a lot of people kind of feel $10,000 is enough, but honestly it might not be enough for majority of people's homes that they want to purchase, because it doesn't give you enough equity in the home in case something happens in the short term where markets might go down, or if you have to sell, there might not be enough room for you to be able to move out in a quick enough manner. And then you're going to see the interest rate. We're going to leave it at 4.25 for now, and then we might adjust that a little bit here just to kind of get a good idea. And then we're going to do the 30-year fixed rate as well, so that way we can get a good idea of the cost that we're going to have for having a mortgage for 30 years. So 30 years is of course a very long time, and we're going to see the effects of how much you're going to have to pay in interest, because we're willing to just pay the exact payments every single month. And you're going to see here on the side, and these of course are estimates. Once you are looking and get the right rates and everything else, it might differentiate just a little bit. So they were saying that the amount that you're going to be paying for the mortgage itself is $1,427. The estimated home insurance would be about $309, and then other taxes and fees equate to about $200. So making your total that you would be paying every single month to own this home is going to be $1,936 every single month. That is not taking into consideration HOA fees or condo fees or anything else that you might have in your given area that you want to purchase a home. So make sure you look into that and take that into consideration. They do have a detailed tab over here that you can go into. Again, it does all those breakdowns for you just so you can see it in a more structured manner if you don't prefer the graphs. But that's going to be just kind of the basics there for you, right? So when we scroll down over here on this website, it actually gives you the recommendations for what you should have as a minimum savings towards purchasing this home, and then the minimum recommended income that you have to be able to purchase a home at this amount. So they're recommending $64,500 is what you should be taking home for an income in a given year to be able to afford this house comfortably, because they understand that being able to live a life where you can kind of do the things that you want to do with your finances, you should be making around this amount, so that way you're not overspending on where you are living. All right, so of course the biggest portion is like how much you're going to actually pay for that 30-year loan, and you're going to see here the total amount of interest that you would be paying would be $223,198. So that's how much you're going to be paying on top of the amount that you're actually going to be borrowing for, which is that $290,000, since we did that 10% down. Now I do understand getting a mortgage is going to be the best way for most people to get into a home, but of course if you just pay those monthly payments, that is a huge chunk of change that you're going to be giving up to somebody else, because you're paying only the minimums every single month to be able to afford that home. Now for me personally, like I said, 30 years is a very long time. I couldn't manage the idea of having to pay something like that for so long. So for me personally, I love the idea of putting more towards the principal, so that way you are actually attacking that debt much faster. As I mentioned earlier, we have that video in the description box down below. You can check that out so you can see how much an impact just $100 a month can actually have on your mortgage. So just imagine what you can do with all of that money, that extra $223,000, if you actually didn't have to worry about that mortgage. As I mentioned though, it is very difficult for a lot of people to be able to pay cash for a home. So I know it's not very feasible, but just always take in consideration of either doing a 15-year fixed loan, so that way you can get it paid off faster and pay a lot less usually over time. And also too, so that way you can be more diligent about wanting to get out of debt and pay that even faster. But if you are going with a 30-year loan, look into the idea of putting a little bit of money extra towards the principal every single month, so that way you can knock off that debt just that much faster. All right, so let's go ahead and change some of these numbers here just to kind of give some perspective for some people. So let's say, you might live in like California or somewhere else where the houses are a lot more expensive. So let's say your house is going for $500,000, and then you're going to put, let's say 10% down. So you put $50,000 down on that mortgage. And let's say you didn't get as lucky and you had to pay 4.75%. So for that loan, the mortgage itself would be $2,347, not including the home insurance or the taxes and the fees. So just keep that in mind. And then when you scroll down over here, you're going to see the minimum recommended savings. So you're close if you did that down payment. And then also too, the minimum recommended income would be over $100,000. Of course, with that big of a household, you would definitely want to make sure that you're earning enough money to be able to pay that monthly payment so you don't lose that house. So if we actually go into the breakdown of the minimum saving, you actually see here the minimum down payment, which of course we said was $50,000. They do have the closing costs estimated to be around $4,500. Now, of course, buying or selling a home, sometimes the closing costs might be, paid off for you based off of, if the person wants to take it covered for you when it comes to the sellers. But just always consider that. And then the recommended cash reserves would be around $9,140, and that's to cover different types of expenses, different types of repairs that will definitely most likely come up, and then obviously potentially filling up a bigger home in that aspect. So when we look at the recommended minimum income, it's just showing you based off of how much you have, and then of course you can add other monthly debts to really give you an idea of how much to have in there for you. All right, so let's go ahead and scroll down over here. So you're going to see the amount that you're going to be paying in at total interest for borrowing on a $450,000 loan is going to be almost $395,000 that you're going to be paying in interest alone if you only pay the minimum balances. Now, that's the critical thing here to talk about, is that that's only if you're paying the minimum every single month. Because if you're adding a little bit more, if you're putting something towards that principal, you're going to be saving more money on the interest and also knocking time off of the actual loan, just like we talked about in the previous video. So that right there, again, is a lot of money that you're going to be paying over time just so you can have that mortgage. And again, I understand if you had to get the mortgage to begin with, but if your intent is to pay it off faster, you're going to be saving a lot of money over time because you're not going to have that house payment every single month. Now, of course, there are some people, as I mentioned, are interested in wanting to, instead of paying extra towards the mortgage, is put that money in investments and earn more through investments. But those are, of course, higher risk and not a guarantee for you to be able to earn that money. So if you're in that category, I'm not against it. I'm just not for it when it comes to the average person wanting to save more money or not have to pay as much when it comes to interest on their homes. All right, and then let's go on the other side of the spectrum here. So let's go ahead and say that you can get a house for $150,000. Maybe you live in an area which is much easier to live on, and you have a down payment. Oh, that'd be a nice down payment. $50,000 on a $150,000 home. But let's say you want to do $15,000 on a down payment. Actually, let's do $30,000. So we're going to do the $30,000, which would be a 20% down payment, which also helps you skip out on PMI, which is private mortgage insurance. And I'm a big fan of skipping out on that. So we're going to go ahead and leave this maybe at like 4.5%, just to kind of get a better idea. So if you live in an area in this home price range, you would be looking at just the home mortgage itself at $608, with everything included around $812. So let's see how much you would actually be paying in interest on a loan of $120,000 at 4.5%. So you would be paying about almost $100,000 in interest just on that loan itself. So even with a good down payment, every single month having to pay that amount, you're still going to be paying a lot of interest if you were to spend it on all 30 years. Now, of course, as I mentioned, if you add anything extra to it, you're going to have a bigger impact on how much you're saving and how much time you're knocking off the end result. So if we wanted to switch over to a 15-year at 4.5%, you're going to see here you would actually only be paying $44,975. So you'd actually be cutting the amount that you would owe on the loan by almost half the amount, and that's awesome. And that would actually be cutting the amount of time that you'd be paying in 15 years. So of course that makes sense. If you cut off 15 years of the loan, Of course, you're going to be saving half of what you would be paying because if it's a 30-year loan. But again, that also puts you in the mindset of having to pay it off. So if maybe you're not good at putting extra down towards it, maybe switching over to a 15-year fix is a better route for you, so that way you're more intentful about actually paying this off. But again, as I mentioned, most of the time if you go with a 15-year fixed, you're usually paying a little bit less in interest. So this would be the same interest as if you were doing the full 30-year loan. So again, it's not really apples to apples in comparison, but if it were, it would still be a better bet for you to do the 15 years because that would be paid off in 15 years versus 30, and that is half of the time frame. So as I mentioned earlier, the link to this website will be in the description box down below. You can definitely check that out and then plug in some of those numbers and, see the different impact that you can have for having a bigger down payment, having, a 15-year versus a 30-year fix, and then how much interest you're going to actually be paying, and keep that in mind for that 30 years because again, such a long time, and that's a lot of money to be giving up to somebody else because, we want to be having that house now instead of saving up for it and being able to pay either a bigger down payment or being able to pay extra towards it every single month.